This week on the Retirement Quick Tips podcast, I'm sharing with you some interesting and hopefully useful articles I've been reading lately. Today, I'm talking about a coming change for investors that provides more access to a wide range of alternative investments like hedge funds, venture capital, private equity funds, non-traded real estate, and private credit. Normally reserved for the wealthy and sophisticated, the rules are going to be relaxing in 2025 on a wide variety of these private or alternative investments. But as Jason Zweig writes in a recent article in the Wall Street Journal, you're better off taking a pass. So here's what the issue is. So I listed a bunch of different alternative assets like hedge funds, venture capital, etc. And these sound exciting. They sound sexy. I've had clients over the years many times who have brought me some idea that somebody else pitched to them because I do not sell alternatives. I don't like them. I never have for a variety of reasons. And actually, Jason Zweig in this article spells it out pretty clearly and very articulately, which is why he's a frequent columnist in the Wall Street Journal. But he says, small-time investors may soon gain easy access to so-called private markets. That usually means higher fees, greater risk, more conflicts of interest, and a harder time selling. And for me, in my own experience in working with clients who have either bought these from somewhere else or when they transferred their accounts, it was part of their asset mix and something that they owned. The harder time selling is the telltale of these types of investments. It's the illiquidity. So maybe you can only sell them at certain times of the year. Sometimes the liquidity vanishes completely and you cannot sell them at all. That is one of the things that makes these types of investments different than stocks and bonds and CDs and exchange traded funds, mutual funds. I can sell those every single day that the market is open and have very few, pretty much never any liquidity issues at all. And there's a reason why these sophisticated alternative private investments have been restricted to wealthy individuals. And that's because they can afford to lose most or all of the investment without going completely broke. The problem is when you have, quote, the little guy who starts investing in these and they put a chunk of money, a very good salesperson convinces them that this is the next big thing, or they're going to get some amazing 28% yield, or they're going to double their money in 6 months. I mean, a lot of these investments, they're not criminal, they're not pyramid schemes. They're just very high risk, highly illiquid investments. They're investing in real estate properties, maybe in funding some startup business. These things by their very nature are illiquid. And again, there's lots of risk. Now, what investment advisors and some investment advisory firms will do who sell these products is they'll package them up, make them all pretty, and then they'll sell them. And unfortunately, they have a lot of times certain quotas to meet. The Wall Street firm, whoever is selling this fund, they're trying to sell a product that pays them an obscenely high fee. So for example, you can buy a stock, a mutual fund, ETFs, exchange traded funds. The fees have been shrinking for years. But if you buy a lot of these alternatives, they have insanely high fees. 2%, 3%, 5%, 6% or more, sometimes can go north of 10%. But it's not so much the fees that I have problems with, although that is excessive and ridiculous, and no one should be buying investments that carry those kinds of fees. It's the higher risk. And on average, a lot of these alternatives, even though they sound very appealing on the surface, if you look back over a long period of time, a lot of hedge funds, for example, don't outperform the broader market. So you took on all this extra risk, you gave up all the liquidity, and you could have just bought an S&P 500 index fund and did just fine, if not even better. And Jason Zweig says in the article, while some managers of alternative assets deliver superior returns, most don't. And getting access to the few outperformers is all but impossible for most investors. So in other words, the best hedge funds, the most well-known, the amazing top of the top, those are reserved for the ultra wealthy. And, you have to know somebody to get access to that. I remember one particular instance that this client of mine many years ago, this is probably 15, maybe 16 years ago, we first started working together and he had bought this non-traded, illiquid real estate investment vehicle. And it couldn't be transferred. He had to hold it at the issuer of this particular real estate investment. So they're proprietary. You can't just sell them at any time. And so this particular real estate fund, I remember you could only sell it in a very small window of time of like maybe 2 or 3 days a year. And you had to jump through all these hoops and you couldn't sell the whole thing. You could only sell a certain portion. So for years, I had to contact the company every year because the dates weren't always the same. I had to contact them like, when's your selling window? Okay, it's March 2nd through the 5th. Okay, so then I had to call back with the client and request liquidation on this specific date. And then they would come back to you and tell you how many shares you could sell that year because it would change every single year. This is the worst type of investment. If I buy something, I expect to be able to sell it at any time. Now, again, if there's certain things that we own that are not like that, like I can't just sell my house at any time. It'd be nice, but it might sit for months before I can sell it. But to not be able to sell an investment and to gradually whittle it down for years, we probably did this for like 5 or 6 years before we could sell all of it. And thankfully, it was only a small fraction of his overall net worth, but the income on it had gone way down. So he was promised, it's going to pay you like 18%. But in reality, he locked up his money. He was still getting income from it, but nowhere near what he thought he was going to get. And it took a very, very long time to sell this investment. So kind of the worst of all situations. And there are others too, but the combination of the risk, the illiquidity, the promises that can go sideways here. Jason Zweig writes that your answer, if a financial advisor or someone ever pitches one of these to you, is just to say, no thanks. Don't even listen to the sales pitch. It's just like DARE's slogan in the 1990s. Just say no. It's just this time it's a different kind of harmful drug, and that is an illiquid investment that, frankly, most people have no business investing in. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.